First off, your reaction to the decision yesterday by the Bank of Canada.
So I understand it. I saw the web poll that you had with people agreeing and disagreeing.
Right.
But I certainly, as a former central banker, very much understand where they're coming from. Now, many people have made the argument that, when you have a shock like the coronavirus and, what is lower interest rates going to do when people are sitting at home and not working and what have you. But it's, in a sense, and this is not terribly satisfactory, but it's better than not doing it. You had the markets begging for it. You had equities in free fall. In Canada in particular, when you have the Fed cutting rates, if the bank doesn't follow suit, you have upward pressure on the currency, which is basically the last thing you need in an environment where global demand is likely to be weak. So I don't think it's going to have a particularly supportive effect on the economy, certainly in the near term. But you're a central banker. You have one tool, interest rates. If it's going to help even a little bit, you're going to use it.
So we don't know how much it helps, but it doesn't hurt.
No, it doesn't hurt unless it sort of suggests to people, wow, there is more to panic about than we thought. And markets had a little bit of that reaction to the Fed and then walked it back, et cetera. So our thesis from an investment point of view and looking at markets has basically been that when this virus emerged as a real sort of market risk several weeks ago, that it was going to be bad for the economy and there was no way around it, regardless of what policymakers do in the near term. But there was likely to be a strong policy response, including from central banks. May not help the economy that much, but was going to provide support to financial markets and asset prices. And I think that thesis is pretty much how it's playing out. Now, from our perspective, there are going to be days of panic and indiscriminate selling. You saw a lot of that last week. Looks like today may be one of those days. So our approach is basically to, in a sense, take advantage of that market panic. So we're maintaining our investment perspective. We're maintaining our risk profile. And when people get really scared and want to sell us cheap assets, we're gonna take them.
And those kind of assets, you're talking about stocks?
Talking about stocks in particular, but also on the fixed income side. Again, whenever you get folks who are not looking at fundamentals and just say, I want to sell everything I can, I want to hide under a rock, it's almost never the right thing to hide under a rock. And certainly our investment process is to never panic. And so again, when you have assets that are being driven down by people being forced to sell or so concerned about everything that they just don't want to have any risk, and it offers us the opportunity to get cheap assets into the portfolios, we're going to take that opportunity.
You don't have these periods all that often. Yeah.
No.
So, yeah.
And that's kind of where we earn our money, right? Like when, markets are just going up, pretty much any kind of portfolio is going to work. It's when things get really volatile that we really sort of earn our keep, so to speak, in terms of, with my job in particular in asset allocation, we're not trying to put the funds in a position for a certain outcome. We're stressing diversification, and we want portfolios that are resilient to a wide range of outcomes in this sort of uncertainty. And that's what we've done, and that's what we're going to continue to do. And to that point, I'm responsible for 29 funds at Fidelity. Virtually all of them are up on the year, despite the pressure that we've seen in markets, and I think that really testifies to the strength of the process.
Okay, so let's talk about what you're going to be watching going forward. You talked about how the markets interpreted what we saw from the Fed, and I guess we were left with the message from whether it's the U.S. Central Bank or the Canadian Central Bank that there could be more coming.
Yep.
They could have more action. Do you think a lesson may have been learned in how the markets responded to what was done this week already that would factor into how they further communicate on any of that stuff going forward?
So I think there were lessons learned, and I know that the governor is going to be on this afternoon, and that's a good question to ask him in terms of the learnings and the communication. I do think we're going to get further easing, and as I mentioned, I don't think the monetary tool is really the best tool in terms of supporting the economy, but it's all the central bankers have. I think what's going to be more important is, in a sense, not liquidity in the center, which the central bank can take care of, but liquidity on the edges of the economy. So if you're a small business, if you're a restaurant or what have you, one of the risks here is people stay home, you get no custom, you get no revenue in, you can't pay your workers. And if that continues to happen all over the place, the economy really does grind to a halt. So you need liquidity on the edges, you need the credit to tide people over if you have an interruption to that business. And that's not something that really can be regulated or legislated from a top-down point of view. So it's going to rely to some degree on the banks, and I'm sure there's going to be, if nothing else, some moral suasion, so to speak, on the part of policymakers and regulators to make sure that liquidity is getting to where it needs to be in the economy.
Okay, so I guess we'll see how flexible individual banks are with talking with their customers to have that flexibility. But I am sitting here listening to what you have to say and wondering what we could hear from the federal government, because obviously we're waiting for the budget, and there are certainly some fiscal tools, even for the individual, that people have been talking about that could come out of what we're dealing with right now. What would you say specifically about that, about what the federal government can do with money to try to skirt some of these issues?
Right. Well, I think we are going to get a fiscal response, and we're seeing it basically around the world, and that's perhaps a better tool than monetary policy as well. It depends on how it's done. So if you have a bigger infrastructure program where you're going to build a new something in 3 years, that's not really going to help the first half of the year, which is going to be bad. But if you have a fiscal response, such as, for example, what they did in Hong Kong, which is basically to say, we know that there's going to be an interruption in the economy, so we're giving everyone 10,000 Hong Kong dollars, I believe it was, to tide them over. If you had that sort of program, and not to say that that's a great idea or a terrible idea from a fiscal point of view, but it is the kind of thing that would give more immediate help and immediate support to the economy. Again, if we do have these interruptions, if people have to stay home, if people are scared to go out or to spend, or what have you.
So if we're talking about connecting all of these dots, and the fact that you have central bank action and potentially more government action, but at the end of the day, you talked about some very simple things. A small business, they have access to capital, they don't want to lay someone off, someone has to work, just all these other variables out there, and you use those words, moral suasion. What will be happening behind the scenes, whether it's the central bank or others, in those conversations that they might be having, for example, with the banks?
Well, I mean, they're going to be frustrating conversations because nobody really knows. So, there are a couple of levels to this, right? So all of us have become, in a sense, sort of amateur epidemiologists over the past several weeks.
It's true.
Whether or not we wanted to be. And our best thinking, both the analysis internally we've done and externally, is this is probably going to get worse before it gets better. But you have some uncertainty there, and then you have the uncertainty in terms of people's reaction, and it's really that behavioral element that's most important, because if people do panic and say, I'm not leaving the house, and I'm going to work from home, and I'm not going out, and I'm not shopping, I'm not doing whatever, it's that effect that can make a potential risk into a real impact, potentially a devastating impact on the economy. And again, it's uncertain as to what the impact will be, because you don't know how people are going to react. So what the central banks are doing, to some degree, the fiscal authorities and regulatory authorities as well, is to try to get ahead of it and, one, calm people down. You mentioned what I did in terms of moral suasion, but also make sure that the support exists in financial conditions and in tax policy, that when we come out of this, after the sort of first half of the year, which is going to be a write-off, that we do have a strong economy and make back some of what we lost.
Okay, and just before you go, David, just given your experience with the Bank of Canada as well, we've used the word coordinated a lot this week, and I'm not sure we quite knew how to define it when, the Fed goes one day, the Bank of Canada goes another day, other central banks, do they have to go all at the same time, or can they do it on their own timetable within a certain time frame? Can you just give us a sense on how you define what coordinated action is and what we could potentially continue to see from these central banks?
I mean, the central banks are clearly talking to one another, and you saw that in Jay Powell's press conference, who said, we're constantly on the phone with one another. You saw the G7 statement. So coordinated doesn't mean everybody cutting rates at the same time or doing fiscal at the same time, but it means that everyone recognizing the risk to the global economy and doing what's right for their own economy. But when you have a real global shock, what's right for the U.S. is going to be pretty close to what's right for Canada, what's right for Europe, et cetera. So it's coordinated in the sense that everybody is responding to the same shock, but it's not coordinated in the sense is, okay, you do this today, you do this tomorrow, et cetera, et cetera.